Okay, talking about Infrastructure and Energy Alternatives Inc. So that's the name of the company. It is not the name of the sector we're looking at, although it does fit. But I know when you hear infrastructure and energy alternatives, you might be thinking that's a sector. It is the name of the company. The ticker is IEA, and their logo is IEA. I'm sure they call themselves IEA for short. Okay, this has been a real wild ride lately. Shares have been mostly up. In fact, our 1 year return, so this time last year to today, is up 350%. However, it's gotten absolutely killed in the last 6 weeks or so. It was middle of January. Shares were trading at about $24. They're now trading at $13. So what's wrong? Well, so far it's all been extraneous events. Nothing at the company has changed. There's not been a report. There's not been a strategic decision. There's not been a merger. There's been nothing. There's not even like change management sometimes. Someone moves stock and move. Nothing. Literally nothing. Okay? The one thing that happened, and I would say it's extraneous, it's not the company, is there was a secondary sale of shares. So what does that mean? A big shareholder owned a lot of shares, decided to sell them not in the market, but on a secondary, meaning they sold them to a broker who turned around and sold them in the marketplace. And you get a deal that, well, actually wasn't a deal. It was below market, and that's typically what it is. You got a lot of shares to move, rather than try and do it in the marketplace, which might move the shares just in and of itself because there are a lot of them. You just sell them directly to the broker and let the broker deal with it. And it was a lot of shares. It was 8 million shares of 21 million shares. So that spooked people. It was definitely below the market. And okay, so fine. But that's nothing the company did, right? It wasn't like revenue was worse than expected or some kind of deal. None of that. It was, just someone else wanted to sell. They locked in some profits. They made some good money. I'm okay with that. That doesn't mean I have to sell. I don't have to feel the same way just because that shareholder owned a lot. All right. The other extraneous factor, very important one, is there's been a major sector rotation in here. Major. In the last 6 weeks. A really short time frame, just like overnight. And it was like a lot of people are getting into regular energy, including us, who said, hey, let's get some regular energy. It looks like time. The price of regular energy, like a barrel of oil, is gone from, well, it was actually negative back, I think it was April in 2020, to $65 a barrel. And it's been much lower, just hovering, not strong prices at all. And it finally looks like it's picking up. The company's leaned right out. I mean, it's been really brutal, and the stock prices are just insanely cheap. So bit of a herd mentality. Time to get into regular energy, including us. We did make some of those changes in our portfolio. And then sometimes you got to sell something. I think one source of cash was alternatives or renewables, and it makes sense to me. You're managing a portfolio. Are you gonna you want to buy some energy? Where are you gonna look? What are you gonna sell? You're gonna sell your high tech. You're gonna sell consumer discretionary to buy alternative energy. No, you probably. Or sorry, to buy regular energy? No, you're probably going to sell your renewable energy. It's just a logical thing. Okay? I do think going forward, though, both can succeed. I do think, renewable energy is the future, right? Fossil fuels are kind of the past. However, both can succeed because the transition is a long one. This is not something you don't switch it overnight. I mean, it could be decades, and it could be beyond my lifetime before we are fully renewable energy. Like it's a long time. Okay, so You got to look at what the individual company. I always say that the extraneous stuff prevent presents opportunities, and you got to look at the fundamentals of the company. All right, so here we are. We don't have a lot of history on the company, but good rate of return, 27% in 2019, and this blue is the trailing 4 quarters. That's 20 or 30% return on invested capital. Fantastic. It's an engineering firm. It's not a lot of capital, so returns can be high. But I can tell you, I know lots of engineering firms, and they're usually lower. There are some that earn 30, but mostly it's 15, sometimes 18, sometimes 12. This is better. Okay, we'll take that. I'll take that any day. What else would I want to point out? Oh, of course, the valuation. Our valuation is, we're saying $52. It's trading at 13. I mean, we don't even normally publish a discrepancy that far. Like, I don't know if I don't quite think it'll actually go to 52. I actually think it is worth 52. Our forecast is very docile. We're saying, okay, it's earning 29% now. Let's fade that to 18. I mean, 18 from 30. That's definitely lower. Okay, you get bigger. It's harder to maybe maintain those returns. Our growth rate is actually very low. It's just plow back, just take the money you earn, put it back in the company. That's it. That is low. You want to look at EBITDA. EBITDA 136 in the trailing. Our forecast is only 209 million EBITDA in 5 years from now. That is not aggressive. That is low. That is low. Okay, the valuation. EV EBITDA. So enterprise value means you take the market cap plus the value of the debt and divide that by EBITDA. That's only 5.5 times. Most engineering firms are in the high teens, almost 20. Some of them are over 20. Okay, so this is like the lowest EV EBITDA engineering firm, like one of the lowest anyways. It's definitely in the bottom quartile. Right? So you get a cheap one. You get one that's earning one of the best returns, and one of the cheapest. Like usually, it's the other way around. You get a high return on capital company, you pay a higher multiple. This is flipped. Okay, I think it's an opportunity. I really do. One last thing. We're going to quick look. We've already been 7 minutes in. Let's go a little quick here. Let's look at the revenue line. It's been growing, as you can see, quite substantially. 88%, 51, 88, 88, 46, 23. Okay, maybe because the growth rate is only 23 and it used to be 80. I guess it's a reason, but bottom line's been better. I think when you do get bigger, it's harder to grow at 80% all the time, but 23 is still pretty healthy. A little bit of seasonality in this, as you can see. December quarter was quite good, and then March was a little weaker. So that 88% is, by the way, relative to the previous March, and this one's relative to the previous December. So I think December is actually a seasonally strong quarter, but the March quarter, which we're kind of in, is seasonally weak. Okay, and that makes sense to me too. They're out building things. It's got to be colder, a little harder to build things. It got to slow down a little bit. It probably makes sense. Okay. One last thing. I really got to wrap this up, but the quarter. I'm normally a buy after the quarter. Make my decision after. If I own it, I wait for the quarter, see how it was good, bad, how did the stock react, and then make a decision. I'm flipping the script on this one. I'm saying you buy before. By the way, it's on Monday, so I'm doing this on Friday. It's Friday, March 5th, around 2 o'clock. It comes out on Monday after hours, okay? So now I know I don't give you a lot of time to act on this, but I'm a buy after normally. I'm flipping it. I'm saying buy before. And in this case, the reason is because the stock is down so much. I believe the expectations have gotten too low. So anyway, halfway decent quarter should move the stock, in my opinion. So that's me wrapping it up. IEA. Thanks for watching our investment video. If you want to improve your portfolio returns, simply subscribe. Or if you're an investment advisor or retail investor and you want help with your portfolio more directly, we can help you with a managed account and manage each and every trade for you.